Another way for banks to get around to paying higher interest on deposits to customers was by creating a new type of deposit called the money market deposit account. Money markets are markets for short-term securities, that is with maturity less than a year, such as T-bills, certificates of deposits, commercial paper, and so on. However, these are high-valued securities out of reach by the common individual. Pooling by creating a fund solves that problem. Mutual fund managers of stock markets were looking for new markets to invest during stock market declines. Investors move money during stock market crashes to cash or interest-bearing securities, such as government securities, as they are of lower risk. To mobilize these funds, mutual fund managers set up mutual funds that invested in money markets called the money market mutual fund. Investors found this to be a good alternative to bank deposits due to restrictions placed by Regulation Q. By the early 1980s, there were roughly $240 billion in money market mutual fund assets. Due to pooling, they offered greater diversification and liquidity than owning individual securities directly. Money market mutual funds were also able to offer check writing privileges through their banks. With mutual funds capturing the bank deposits market, banks were allowed to compete with money market mutual funds by creating a new deposit called the money market deposit account, or the MMDA, under the Germain Act of 1982. The MMDA offered competitive interest rates and checking facilities, however, at the expense of higher risk, since money market instruments are subject to some interest rate and credit risk. So let's conclude this section. We now know enough about the factors that affect money supply, how changes in interest rate cause changes in the behavior of economic entities such as households, firms, governments, and the rest of the world. We saw how increases or decreases in banking loans can cause shifts in the money supply and in turn interest rates. We also saw the direct and indirect effects of loans of funds on interest rates. We then studied the importance of reserves and deposits in a bank's ability to generate loans. We studied how banks manage their liquidity through asset-liability management. Finally, we looked at some regulations and various instruments that banks use, such as repos, reverse repos, federal funds, the euro-dollar deposits, and money market mutual funds. With this knowledge, we should have the sufficient foundations to understand the implementation and determination of monetary policy. But before we dive into the details of the monetary policy, let's gain some clarity on a few more fundamental concepts so that we do not get lost when we try to understand the Federal Reserve Bank's monetary policy.